Take a close look at the top edge of a dollar bill. The text reads Federal Reserve Note. It does not say United States currency. The U.S. Constitution explicitly gives Congress the power to coin money, yet the currency you use every day is issued by a separate hybrid institution that sits outside the standard branches of government. This arrangement is not some hidden conspiracy. It is a highly documented, deliberately fragmented bureaucracy hiding in plain sight. To understand how the system actually functions, the popular metaphor of a government printing press churning out sheets of paper must come to a complete halt. The physical manufacturing of cash is only a tiny fraction of the mechanics at play. Modern money is a strict architectural stack relying on digital ledgers and legal boundaries. At the foundation is the commercial bank layer, where your daily money is created. Above sit policy controls throttling borrowing and constitutional oversight governing the structure. You have to map this entire stack to understand who actually has the authority to expand the money supply, and ultimately who dictates the value of your wealth. Start at the base layer. When your employer deposits a $3,000 paycheck into your checking account, you see the balance increase on your screen. The common assumption is that the bank takes that specific $3,000 in cash, places it in a vault, and holds it there until you ask for it. That model became obsolete centuries ago. Historically, people stored actual physical gold with goldsmiths, receiving paper receipts in return. The goldsmiths quickly realized they could write out more paper receipts than they had gold in the vault, betting that not everyone would demand their physical metal on the exact same day. That practice evolved into what economists call endogenous money theory. In the modern banking system, when a bank issues a loan, it is not handing the borrower someone else's pre-existing deposit. The bank creates brand new money by executing a few keystrokes. If you deposit $10,000, your bank leaves your account balance completely untouched. When a small business comes in to borrow $9,000, the bank simply credits the borrower's account with $9,000 of new digital money. The original deposit remains, and $9,000 of entirely new purchasing power now exists alongside it. This process historically relied on the money multiplier effect, governed by a strict legal boundary, a 10% reserve requirement dictating exactly how much cash a bank had to hold back. In March 2020, the Federal Reserve dropped the mandatory reserve floor to 0%. Mathematically, the old formula breaks. What stops banks from issuing infinite loans? A new capital requirement. Banks must now hold enough of their own equity to absorb losses. Commercial banks control the daily engine of money creation. But their throttle is no longer a physical vault of cash. It is a complex wall of risk algorithms and equity buffers. One level up the stack sits the architect of the system, the Federal Reserve. The Fed operates as a hybrid entity. It functions as an independent central bank, insulated from immediate political pressure because its governors serve staggered 14-year terms that outlast any single presidency. Despite how it is often described on the news, the Federal Reserve does not control the money supply by turning on a physical printing press. Its real power is entirely digital. To inject liquidity into the banking system, the Fed relies on open market operations. This digital ledger shows the mechanics. To expand the money supply, the Fed purchases $20 million in government bonds from a commercial bank. It doesn't use tax revenue. It pays by simply typing digital reserves into the bank's account at the Federal Reserve. That keystroked base money flows into the commercial bank, providing the exact liquid foundation the bank needs to multiply its own consumer lending. Today, the Fed manages this entire process using a highly precise steering wheel called Interest on Reserve Balances, or IORB. By paying banks a specific interest rate to park their money safely at the Fed overnight, the central bank dictates the exact minimum risk-free return a commercial bank is willing to accept. Raising the IORB rate forces an upward shift across the interbank lending market, setting a hard floor under borrowing costs. This single adjustment cascades downward mechanically, forcing interest rates on consumer mortgages, auto loans, and credit cards to rise in tandem. The Federal Reserve governs the money supply for the largest economy on Earth without ever touching physical cash. It simply types digital ledger entries to throttle the baseline cost of borrowing. Ascend to layer 3, and you find the government's side of the equation. It is vital to understand that the Federal Reserve and the U.S. government are distinct entities with entirely different authorities. The U.S. Treasury processes tax revenue and government spending. To do this, the Treasury quite literally maintains its own checking account at the Federal Reserve. The physical manufacturing of bills and coins is handled strictly by the Treasury's Bureau of Engraving and Printing and the U.S. Mint, who then sell that physical currency at cost to the Fed for distribution. Congress and the Treasury control fiscal policy. They decide exactly how much the government taxes, how much it spends on public programs, and how much debt it issues. The Federal Reserve exclusively manages monetary policy. It decides the underlying cost and volume of the currency flowing through the system. There is a deliberate, structural firewall placed between these two institutions. The entity that decides to spend the money does not have the authority to create the money. The logic behind this separation is a defense against political incentives. Elected officials face short election cycles. They have a permanent temptation to order the creation of cheap money to juice the economy and appease voters right before an election. When you allow the same officials who authorize spending to also command the printing of currency, the inevitable long-term result is runaway inflation that destroys the purchasing power of the fiat currency entirely. Central bank independence was engineered specifically to prevent the type of systemic economic collapse seen throughout history when governments printed money to cover their debts. This strict division of power is the primary safeguard intended to stop politicians from quietly taxing the public by inflating away their wealth for short-term political victories. That brings us to the very top of the stack: congressional oversight and constitutional law. Because the independence we just mapped out is currently undergoing an active legal stress test. The committee that dictates interest rates is the Federal Open Market Committee. Its permanent voting bloc relies on 7 governor seats, each appointed by the president and confirmed by the Senate. To maintain the firewall, these governors are shielded by law. They are given 14-year staggered terms, and the statute states they can only be removed early by the president for cause. In August 2025, the White House attempted an unprecedented action: the direct removal of a sitting governor, Lisa Cook. The administration justified the firing by alleging Cook committed mortgage fraud on personal loan applications in 2021. Cook denied the allegations completely and immediately filed a federal lawsuit to block her removal, directly challenging the executive branch's ability to interfere with central bank autonomy. Over the following months, the case escalated through the court system. Amidst this legal friction, the Senate confirmed Kevin Warsh to take over as the new Fed chair in May 2026. The conflict reached its climax on May 15, 2026, when a 5-4 Supreme Court decision officially blocked the White House from firing Governor Cook. This timeline details exactly how precarious that ruling was. The court blocked the firing, but only on narrow procedural grounds. The justices ruled the administration failed to provide proper legal notice before the removal. They pointedly declined to rule on whether the underlying fraud allegations legally constituted cause for termination. This leaves the defining threshold for central bank autonomy completely untested and entirely open to future executive challenges. At his very first meeting as chair, Kevin Warsh dropped language signaling rate cuts and hinted at a possible rate hike, a hawkish move that directly contradicted the political expectation that he would deliver cheaper money for the administration. The events of the last 12 months force a massive, unresolved question onto the system. Can a regulatory architecture designed in 1913 hold up against intense modern political pressure when the courts deliberately leave the back door open? When you look at the entire stack, from the commercial bank keystrokes to the Supreme Court docket, you realize what actually backs the dollar. It is not gold, and it is not math. The U.S. monetary system rests entirely on a fragile, actively contested legal agreement.